Hey traders, Jason here from Leavitt Brothers. Hope you're well. The market is mostly in consolidation mode. The indexes have moved sideways in ranges for several weeks or longer. Many leading stocks are resting in ranges. I did a video about this 2 days ago. So in this video, I'm going to show a couple of breadth indicators that have started to deteriorate some. Okay, not all indicators have turned down, just a couple. Okay, so like the hint is not that something is urgent, but it's just kind of a little bit of a hint that, like, hey, there's a little bit of weakness starting to show beneath the surface. We need to pay attention to it. But overall, the market is still in decent shape. All right, so let's go through a couple of these. All right, so here is the S&P 500, and the middle here is the 10-day moving average of the NYSE AD line, and the bottom is the 50-day moving average of the NYSE AD line. Okay, so generally speaking, if I were to back up some, when the 50-day of the NYSE AD line is above zero, that defines the overall uptrend, and then the 10-day will define ups and downs within the trend. Okay, so this is kind of like the trend, and this is more like a timing mechanism within the trend, if I could do it like that. So with the 10-day, divergences down to zero tend to lead to pullbacks. Divergences at higher levels tend to lead to a little bit of weakness, but not much. Okay, so for example, you have higher highs here, divergence down to zero, and you get a pullback here. You get market trending up here, divergence down to zero, and you get a pullback here. Okay, market moving up here, you get a divergence, but it's at a higher level, so you just get a small pullback. Okay, so what we have right now is we have a bigger divergence playing out over a bigger time frame. Now, when it goes down to zero and recycles up, I tend to start the indicator over again, and I tend to like ignore this, and I think of it as starting over. It resets. But still the absolute print here isn't that great. It's down near, it's under 200. It's getting close to zero. So it's something to pay attention to. You have a divergence in place, okay, from the higher high here. We're getting closer to zero. So it gets to the point where like this thing either needs to bounce off zero and reassert itself, or it's going to go below zero and induce some sort of a pullback. And in this case, the pullback probably is going to come down here, maybe to 3,100, maybe 30.50 down to where the 200-day is, 200-day moving average. Okay, overall, 50 is above zero and in good shape. So this defines like the longer term uptrend, and then this is the shorter term oscillations within the trend, which tells you a little bit of weaknesses seeping in here. All right, next one is, this is the Nasdaq. And this is the 10-day moving average of the Nasdaq 80 volume line, and this is the 50-day 80 volume line. Okay, so the difference between this chart and the last chart is with the AD line, all stocks are treated the same. It doesn't matter if you're Apple or a small, $200 million company, they're treated exactly the same. It's just advancers and decliners. With the AD volume line, what you have is the stocks with more volume count for more. Okay, which is a little weird in and of itself, because you could have a small stock that trades a lot of volume, or a big, or like an expensive stock like a Google or Amazon that trades less volume because it's so expensive. You kind of wonder like what would the indicator look like if Amazon split 20 for 1 or Google split 20 for 1. But nevertheless, the indicator still is useful to us. Okay, so similar to the last one, oscillations above zero for the 50 define the longer term uptrend, and then the 10 defines like cycles within the overall uptrend. Okay, and divergences down to zero tend to lead to pullback. So here you have move up, divergence down to zero, and you get this drop. You get move up, divergence down to zero, and you get a drop here. Move up, divergence, but at a higher level, so it doesn't go very far. Okay, and then so we have move up, divergence, but it happened at a high level, so it didn't really induce anything. But now we're starting to get now we're starting to get a divergence over the course of a longer period, but it too is at a higher level. Okay, nothing urgent, just something to pay attention to. We'll see if this thing can continue down and maybe bounce, or if it continues down and goes through zero. Another sequence would be a higher high here, and what if this thing dropped and then we got to move up to here, and then we got that. Okay, so that's something to pay attention to. That would be the divergence at a lower level. Okay, this over here being so high tells us long term the market is healthy, it's strong, it's got an like underlying strength. Okay, but in the near term, there's starting to be a little bit of a warning. Nothing urgent. Okay, you don't have to rush out and sell everything, but it's something to pay attention to if you trade shorter time frames. Next up, S&P 500 versus high beta stocks at the end, S&P, and low volatility stocks. Okay, so the S&P is like 500, maybe 505 stocks, because some of them like Google have split and they're both in there. So high beta stocks are the 100 highest beta stocks in the S&P, and the low volatility is the 100 lowest volatility stocks in the index. So the market tends to follow the high beta names. When the high beta names don't confirm the S&P, you tend to get a reversal. Okay, so for example, market higher high beta names just simply matched their high, and then the market fell. Okay, higher high here, high beta names matched their high, and the market pulled back. You have higher high here, high beta names couldn't make a higher high, and then the market fell. Okay, and so like right now you have higher high beta names not even coming close, and so it's something to watch out for. Okay, another thing to note is that what happens is the high beta names start to bleed down, and then the low volatility names move up. So like for example, I'm going to change the color here. So for example, you have higher high here, lower high here, but the low volatility names made a higher high. So it tells you that money is kind of shifting from the high beta names to the low beta name, low volatility names, and that's partly what induces the sell-off. It's a little bit of it just kind of tells you that money's rotating within the index. It's coming out of the growth stocks going into like the more boring stocks, and that's a little bit of a warning. So we're getting that right now. Okay, as I said, we have higher high here, lower high here, but the lower volatility names are moving up. So money is shifting from here over to there, and that's a little bit of a warning. Next up, we have this is the 1 month. This Nasdaq 100 1 month high low. So within the Nasdaq 100, which I think there's a couple more than 100 stocks, how many stocks are making a 1 month high versus how many stocks are making a 1 month low? Okay, divergences tell us deterioration is taking place. Okay, so market up here, less names at a 1 month high low. It continues there, and you get a smaller divergence there, and then of course the market fell. The blue line is the Nasdaq 100. Yet Nasdaq going up, 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 and then high low, putting in lower highs. Okay, so that's basically how it works. If the market, if the market goes, let me change this. So if the Nasdaq 100 is right here, and this is the 5-day moving average of the 1 month high low, is wherever it is, just pick a number. And then if a couple weeks later the Nasdaq is at a higher level, but less stocks are trading at a 1 month high low, that's a warning. Okay, so if you had like 40 stocks trading at a high low, and then only 30 the next time around, that tells you less stocks are participating. So right now we have Nasdaq moving up, higher highs. We have indicator moving down, lower lows. So less and less stocks are participating. It's a little bit of a warning. Okay, last one. Summation index, Nasdaq summation index. Okay, higher high, lower high. Okay, big sell-off. Higher high, and then lower high there, big sell-off. Higher high here, lower high there, higher high here, lower high there. You tend not to get a whole lot of downside movement just simply because the indicator rolls over. But a month later, or a couple weeks later, when you get a divergence, that's when you get a bigger sell-off. You can see the sell-off here. You can see sell-off here. Obviously, this one was aided by the coronavirus picking up steam. So who knows what happens here? But it's definitely worth paying attention to the fact that this thing has rolled over and is trending down now. Okay, so not all indicators are issuing warnings. Okay, that's not going to happen all at once, but when I see the indexes trading in a range and many key leadership stocks trading in a range and some breadth indicators start to issue warnings, I take pause. Okay, I'm long the market. Okay, I don't have any shorts right now. I'm long, but I'm not being super aggressive here. Okay, thanks for listening. Come check us out at Leavitt Brothers, where we offer market analysis and trading ideas to the financial community. All first-time subscriptions come with a 2-week free trial, so there's no risk checking us out. All right, see you next time.